Marcellus's monthly webinar on consistent compounders. We'll give you an update on how the portfolio's fundamentals have progressed, and we've preempted a few questions, and there's a lot of detail that we'll be sharing around a few specific stocks as well, where performance-oriented questions I'm sure will be coming from you. And with me is Salil today, and after the initial bit of download on the performance, Salil will help us raise the questions that you guys would have asked, and we'll try to answer them as much as possible, as best as possible. So let me share my screen. Right. Okay, so when it comes to the portfolio performance, quick data points. So last 1 year has not been a very good one from a performance standpoint. You can see the minus 1.4% versus positive 7.9 for Nifty total return. That's a good 9.5%, 9 to 9.5% underperformance. On a 3-year basis, though, on a 4.5-year basis, on a 3.5-year basis, though, it's a very healthy absolute return as well as relative return, 18 to 20%, which is around 3 to 7 percentage points higher than Nifty 50. Now, digging into the drivers of this underperformance, particularly over the last 1 year. So this is a quick update on the chart that you might have seen a couple of webinars back, reflecting on which stocks in Nifty 50 have pulled up the performance of Nifty over the last 1 year. The encircled names, you can see bulk of them are commodities and utilities. Commodities who are producers of commodities where commodity prices are on the up. The share prices have done well, and utilities perhaps because not much of FII ownership is there in those stocks in a market which has seen massive FII outflows, have also seen those stocks do well. We don't own any of those two sectors, and hence there's a bigger negative skew to the share price performance of our portfolio companies compared to Nifty 50. Now, the reason why we don't own them is because we are not convinced that these companies in commodities and utilities sectors have high pricing power and ability to sustain it over the long run, which would make them fit into our philosophy and hence the portfolio. Having said that, obviously a direct question from this is that at Marcellus, we've always talked about the resilience of our product relative to the market during a stock market crash, and this chart clearly doesn't show that resilience. So typically, just to recollect, over the last, say, couple of decades, if you look at stock market crashes of 15-20% or more, out of every 5 such crashes, around 4 will see massive resilience, and 1 will see a lack of resilience. That's been the way empirical evidence has been. So whether it be the FY20 period of COVID crash, where we outperformed by some 33 percentage points, positive 8% return of CCP versus minus 25, or whether it be the Island FS crisis crash in October-November 2018, the capital gains tax introduction related crash in Feb-March 2018, the taper tantrum 2013, 2015, so on and so forth. All of those stock market corrections were overlapping with our portfolio companies and the overall portfolio not falling much, in fact going up in some of those cases. But for instance, demonetization, this chart shows you, was very similar to the experience of the last sort of 6 to 12 months, where exactly the same list of stocks in the red dotted circle on the left, from the same 2 sectors, they lifted Nifty up, and our portfolio companies, they didn't belong to those sectors, and they led to the group as a whole of our portfolio companies led to about 10 percentage points underperformance. It's actually very interesting to also note that during the resilient times, say the FY20 period, right, where 6 months to 31st March 2020, or since inception, you can see the encircled part, which is the worst performers for Nifty. They actually delivered. The encircled part includes the same commodities, utilities, stocks, which have lifted the Nifty up over the last 6 to 12 months. So whether it be Hindalco, GAIL India, JSW Steel, Tata Steel, ONGC, L&T, Adani Ports, so on and so forth, that circle that you see on the left, that was the one which dragged the market down when our portfolio was far more resilient. So that's a dissection of the last, say, 12 months of underperformance. Now, why do we believe that this is not because of valuations? So again, a quick recap of this slide, which we did a couple of months ago. If you end the price to free cash flow multiples in FY21 and look at the journey till FY21 for the preceding 5 or 7 years, there isn't a price to free cash flow multiple expansion. And our portfolio companies' stock prices have moved pretty much in line with their free cash flows over the preceding 5 or 7 years, which is clearly a reflection of the lack of overvaluation being the reason for the last 12 months of weak performance of these companies. Now, coming to fundamentals, which give us a lot more comfort. In fact, we're quite encouraged with how fundamentals of our portfolio companies have progressed over the last 1 year, 2 years, 3 years, particularly through the COVID period, and how their capital allocation decisions over the last couple of years give us a lot of promise for free cash flow compounding over the next, say, 3 to 5 years. So first and foremost, for the most recently reported quarter, the weighted average growth of revenue and earnings was mid to high teens. The return on capital employed was around 40%. Now these are numbers which are a little healthier than long-term averages. Particularly if you look at the revenue and return on capital employed, very encouraging numbers there. Compared to Nifty 50, a gap of good sort of 15 to 20% maintained around return on capital, which is also the source of higher free cash generation for our portfolio companies. When you look at full year numbers and then go for comparisons across the last 1, 2, and 3 years, the FY22 on a 1 year basis obviously was a very, very strong year. Even on a 2 or 3 year basis, the encircled part at the bottom shows you the sort of mid to high teens rate of growth in earnings. Now, FCFE is something worth spending some more time on, because you would have heard us talk about sort of 20 to 25% FCFE growth, free cash flow growth of our portfolio companies over any sort of 5 year time horizon or 10 year or a 20 year time horizon. Typically, and over the last 5 years in particular, it's been only a 3% growth in FCFE, and the reason for that is because financial year 22 has seen a minus 37% FCFE, as you can see on average. Right now, what is it? Should we be concerned, or is this because of something that we should be excited about, encouraged about? So first and foremost, breaking down the revenue growth progression into its biggest component, which was accelerated market share gain, right? So whether it be Dr. Lal PathLabs most recently reported quarter or the quarter prior to that, the jaw opening versus even organized competitors like, say, a Metropolis or a Thyrocare is massive, right? This is on top of a good market share gain, which would have happened for the entire organized sector in diagnostics from unorganized sector. And within organized, Dr. Lal is gaining a lot of share. Likewise, for Asian Paints, Berger over Nerolac, Axo, there's a massive gap opening up gradually, consistently for the last 2 or 3 quarters between revenue growth rates amongst organized players here. And similarly, the experience of the lenders, where sort of a 20 to 30% rate of loan book growth compared to an industry average of sort of high single digits. right? Now this is the driver of revenue growth. It's on an accelerating trend, as you can see. It's the gap opening is sustained quarter after quarter, and in fact becoming bigger as time progresses. We'll come to the drivers of market share gains looking out into the next 3 to 5 years in a bit. This slide talks about profit margins. As you probably know, many of our portfolio companies are consumers of commodities whose prices have gone up significantly, right? Here are two examples. So Asian Paints, which consumes crude oil derivatives. For instance, TiO2, one of the key ingredient into paint manufacturing, its price is up 60 to 70% over the last 12 months. Crude oil price itself is up, I think, roughly 3x over the last 2 years. And hence blended raw material inflation of 30 to 35% over the last 12 months is what Asian Paints has experienced. Now, they haven't hiked prices by 35%. Instead, they've derived a lot of operating efficiencies, and through those, the margins have been pretty much coming back in line now. You can see the EBITDA margin. EBITDA margin fell from the sort of 22, 24% levels down to 13%, and it's now coming back up to the extent that next 1 or 2 quarters, I think, given the kinds of price hikes and the operating efficiencies that they continue to take out, next 1 or 2 quarters we'll be back to normalcy. Likewise for Page Industries, here yarn prices for Page are up about 100% year on year. They have literally doubled over the last 12 to 14 months. The gross margins of Jockey, Page Industries, they've been really robust. And likewise for their EBITDA margins. And this is helped by partly operating efficiencies, some price hikes, and also some strategic inventory accumulation that Jockey has done, which has led to obviously its inventory days go up, and I'll reflect upon this on the free cash flow slide. But net, there are some very interesting levels of resilience in the profitability despite raw material cost inflation that we've seen in the last 3, 4, 5 quarters for these companies. Now coming to free cash flow, why has it not grown, and why are we not worried about it? If you really see a 5-year rolling free cash flow CAGR, 14 to 19, 15 to 20, 16 to 21, there's not much of weakness, despite the fact that say a 16 to 21 FCF CAGR would have included all sorts of black swan events like demonetization, GST introduction, the entire IL&FS crisis, and COVID, right? All of that was part of the 5-year period of 16 to 21, and still the free cash flow compounding was consistent and healthy at around 20 to 22% levels. It's only in FY22 that free cash flow has actually declined meaningfully, which has led to the 5-year number of 17 to 21 show a lot of weakness. Now, what are the reasons? This is more capital allocation in an accelerated manner. Working capital increases to benefit from strategic decisions around availability and pricing of raw material. Those are two key components, if I were to summarize, and there are examples of let's say all the non-financial companies where free cash flow has moderated. So Asian Paints, its inventory build up as a strategic decision to overcome global supply chain disruptions better than their competition, and you can see that's driving volume growth, margin resilience, much better than their competitors. Just to highlight, competitor Nerolac, although half of Nerolac's business is B2B car, auto OEM paint, industrial paints, but even though the remaining half is decorative, they reported a 70% drop in profit after tax in the 4th quarter compared to Asian Paints, which reported a double-digit increase in profit after tax in their 4th quarter, right? So that's the outcome of all these sort of strategic decisions, where working capital is a tool that these companies are playing around with to overcome the challenges thrown by sort of shortage of raw material and high pricing of raw material. Likewise for Berger, just that Berger additionally also had a 750 crores capex in the last year for their Lucknow plant. And paint companies, they do lumpy capex. This is not the first time that their free cash flow has declined because of capex. It has happened once, typically every 4 to 5 years. Dr. Lal Path Labs, obviously Suburban acquisition was massive, and against a sort of operating cash flow of hardly, I think, a couple of 100 crores. They had a 925 crores of payout for the Suburban acquisition, and hence a massive drop in their free cash flow. Titan piled up inventory to, you can read the quote, Titan piled up inventory to benefit from increased demand that they could see for their products coming up in the first quarter of FY23, right? And these kinds of strategic inventory pile-ups to cater to upcoming high spike in demand is something that ends up benefiting, and I'm sure for the first quarter of FY23 you'll see the outcome of that for Titan. Likewise for Page, and Page categorically also called out that the inventory pileup that they've done in response to anticipated high levels of demand in the coming quarter, that inventory pileup is all in fast-moving goods. It's not in products which could be categorized as dead inventory that they've manufactured and they hope to sell. These are all their fast-moving goods which have led to higher inventory, and hence it's a strategic reason for a decline in free cash flow. Pidilite, very interestingly, if you look at the capex intensity of the last 3-4 years, for Pidilite, they've spent 4,000 crores in capex over the last 5 years, FY18 to 22, both years inclusive. They've spent 4,000 crores, which is 4 times higher than the preceding 5-year period cumulative capex that they've done, right? And this is where they're setting up more than a dozen odd plants, new plants, manufacturing plants. They've acquired Araldite for 2,000 crores, so on and so forth. And this is all sort of fuel that they're accumulating to fire up growth into the future, rather than anything that should be worried about in terms of their cash generation. Now, that was more the fourth quarter number, the FY22 free cash flow drag related drivers. But in general, if you look at the last couple of years, there have been 3 areas where our portfolio companies have accelerated capex, because of which, on the one hand, they are gaining more share, right? So the revenue growth rates have accelerated, you saw in the previous slides. But certainly in the short term, it is having an adverse impact on their FCFE growth. But this is a temporary phase that these high quality companies periodically go through. So in FY9 and FY10, both of those years, despite healthy revenue and earnings for these companies, the entire set of companies in our portfolio had negative free cash flow for both those years. FY13, again, there was a negative free cash flow. FY17, again, there was a negative free cash flow for the group as a whole, the bunch of stocks as a whole. So this does happen periodically whenever they press their foot on the accelerator to do capex. And this slide sort of demonstrates 3 types of capital allocation decisions. Firstly, acquisitions. Secondly, a lot of tech capex. And thirdly, complete business transformations from sort of traditional business to new age business. A couple of companies in our portfolio are undergoing that. Right now, coming to the sort of tech capex bit in particular. This is something worth taking notice of. There are lots of people talking about India doing capex or not, and whether capex in India is rising. Something which is quite interesting to know is that, unlike, say, the capex of the noughties, in the last 6 years, intangible assets capex, intangible assets have grown at a much faster pace than tangible assets on the balance sheets of Indian corporates, and a large part of that is around IT projects. Right, a 16% CAGR in IT projects is massive in the more recent years, and this, when looked in light of what sort of tech capex can companies do and are doing, there are actually two types of technology investment journeys that a business can follow. So the traditional business starts from, let's say, the enterprise resource planning software, the ERP software as they call it. So at the point of sale or at the manufacturing plant level, you would do an ERP software to collect data about that particular function, right? That's the first step of tech investment that a typical traditional company does. Once you get the data at a function level, then you start building some muscle around it by doing supply chain optimization, manufacturing process optimization, and a lot of technology investment goes there, which is sort of the muscular development of the corporate body in a sort of figurative manner. And then once this stage has been cleared, comes the sort of new age type of tech investment around data analytics, demand forecasting. So the stuff that, say, a Blue Yonder does for Jockey, the stuff that that Asian Paints has been doing via i2 Technologies for a couple of decades now. And then finally comes the customer interface, right, which is sort of the face of the business, where it would be either an app or the interface, physical or digital or omni-channel, that the business builds with the end customer to sort of build loyalty, interact, and evolve with the way the customer engages with the business. Now, a traditional business goes bottom up. Typically, the bottom two layers require a lot of patience. And once you've done the bottom one or two layers, the business has the potential to generate a lot of cash, redeploy that cash, and do these tech investments, right? And with that cash, then a traditional business goes up to data analytics and customer interface. Whereas a typical journey of a sort of quote unquote born digital company, which many people want to call new age businesses, right? The typical journey of a new age business in tech investment is actually top down. They first spend in customer acquisition, right? CAC is a very commonly used term, customer acquisition cost, that businesses incur because they are acquiring customer without having built the bottom three layers yet. A large part of this customer acquisition cost actually ends up sort of making the business unprofitable in some instances, and hence tech investments become a far bigger number than say the profits or revenues that the business generates from the customer, if at all. And then these new age companies, they do data analytics. Typically, this journey of customer interface to data analytics is funded through external sources of capital, venture capital, private equity, etc. If the business is not yet making money internally, internal cash accruals to fund this sort of a tech capex. And thereafter starts the process of doing the third and the fourth layer, the business process of optimization and ERP. The challenge that a new company, a new age company typically faces is, if the funding dries up after the top two layers, then obviously the bottom two layers can't be executed. And if the whole journey from top to bottom isn't completed, then the business doesn't see high returns on capital employed till then. And that's a big challenge that these companies have to deal with, right? Doing all four layers requires time, effort, patience, and building a lot of competitive advantage through the process, so that by the time you become a cash generative company and reinvest that cash to drive growth, you need to be able to sustain, build a fortress around it, defend yourself against competition, macro, so on and so forth. So that's the journey typically. And hence, when many people ask us whether we are invested in tech as a sector or not, given that most companies in our portfolio are using the bottom-up journey rather than the top-down, in fact, our portfolio is quite tech-heavy, just that it's from the traditional to new age transition of tech rather than the other way around that these companies attempt. And here are some examples and their impact. So, for instance, the kind of operating efficiencies that Asian Paints and Page Industries have done through the bottom layer, right? The bottom two layers, the ERP, the supply chain management software of Asian Paints, that has been in works for the last couple of decades. For a Page Industries, the kind of efficiencies that they've dug out from manufacturing plants, where their productivity of volume per unit labor employed. So volume produced per unit labor employed in the manufacturing plants. During FY11 to 16, it went up by a CAGR of 4%. And that's massive productivity improvement. All of those sorts of initiatives, you can see what they led to the financials of these companies over the last 5, 10, 15 years. Free cash flow compounding for Asian and Page was far greater than earnings growth, right? And this is the ERP, the muscular buildup benefits that these companies have derived. And then comes the second type, which is a little more new age oriented, where an Asian Paints is transitioning from a product provider to a services provider through their in-house 3D visualization tools when they offer home decor via the in-house architects, and then sort of customizing their offering in home decor, something that a live space or a home lane has been doing, but our channel checks suggest that what Asian Paints does adds far more value to the client, gives more customization to the client, and Asian Paints' execution, thanks to the kind of systems and processes that they put, is far superior, far better in these areas, and that's the transition that Asian Paints is undergoing. Page Industries in particular is a business which has totally transitioned. 5 years ago, Page was heavily underinvested in technology, and that was also one of the reasons why after the GST introduction in 2017, Jockey's supply chain couldn't help their distributors and dealers, as well as maybe some of the other portfolio companies that we had who dealt with GST in a far better manner. But in the last 4 or 5 years, Page Industries' tech capabilities have totally turned a corner. So they employed Big Blue Yonder 4 years ago. They have plugged that into auto replenishment system of their supply chain, where the distributors' inventory levels have gone down because he sits on less dead inventory. Jockey's inventory levels have gone down over the last 5 years because Jockey doesn't sit on too much of dead inventory as in products that Jockey has manufactured but the distributor hasn't yet ordered, because it's the demand forecasting software that is driving optimization of raw material procurement, manufacturing, and they're manufacturing exactly what they'll sell. They're selling what exactly the distributor will be able to sell to the retailer, right? That's what they've done, and I'm sure this is one of the reasons that has helped them manage a much wider range of products over the last 4 or 5 years, to getting into kids wear and loungewear as much wider categories than they previously used to have in innerwear till a decade ago, let's say. And that too, doubling of their multi-brand outlets literally over the last couple of years, right? From 55,000 in March 22, over 110,000 in March 22. That's not an easy thing to achieve with stable working capital cycle. Titan has embarked on a different journey altogether over the last 5 or 6 years, in particular after they acquired Carrot Lane as a majority stake. And Carrot Lane is becoming a big source of sort of tech, becoming part of the DNA of Titan in terms of how this business now thinks about customer data, understanding of the customer, and then accordingly orienting your offering to the customer, modifying it to add more value. Bajaj Finance, many of you have known Bajaj Finance as a lender using tech, and you would be aware now this firm is transitioning more into a fintech than just a tech using technology. So those are the examples of sort of new age transitions from traditional businesses, the top 2 layers of tech investments, practically speaking, that our companies have done. Very quickly, this is where I was talking about 5 years ago, Page being underinvested in technology. When the challenges emerged, there were moderations in revenue growth rates, and hence the more our portfolio companies invest in tech, which is what they've done in the last 2 years, the more resilient and greater market share gains do they see in the years to come. Now, coming to a few stock-specific data points, so I'm sure you would all be thinking about over the last month or two when Asian Paints' share prices fell against the news of Grasim doubling its capacity, so on and so forth. So I thought of just addressing that point, and also on Dr. Lal PathLabs versus the rising competitive intensity there. So a quick couple of slides on these two. When it comes to Asian Paints, let's not forget the nature of the beast here, the nature of the industry is that paint is a voluminous product. It's a chemical, right? Along with that, channel margins currently are barely 2 to 3%. Obviously, when it comes to MRP, the channel margins are a good 18 to 20%. But when you think about the price at which sale happens, you should just walk out from your house and do this check yourself. It's amazing. The entire channel's margin is hardly 2 to 3% in page in a very voluminous product. Then that means the only way paint dealers on the high street can make money is through inventory turns. Now, it would have been all right delivering inventory turns had there been sort of lots of layers in the channel efficiently working their way to deliver those inventory turns. Here, in fact, there are no wholesalers or distributors involved, right? Asian Paints reaches out directly to 150,000 dealers on the high street and provides inventory turns of the order of 3 to 4 hour delivery times once the order is placed, with fulfillment of high 90s, as in order fulfillment being high with 3 to 4 hours of delivery time. Now, doing that via direct sales in a voluminous product is the big challenge, right? There are two ways in which this challenge can be attempted. A solution to this challenge can be attempted. The first way is what Asian Paints does. Forecast your demand well. For that, obviously, you need several decades, not just years, several decades of understanding of demand patterns of your products. Forecast your demand well, and then ensure that you also have a front end which helps you connect the last mile, which is, let's say, the area sales manager of an Asian Paints sort of indicating to a paint dealer where a new demand is coming up and where the supply of paint product from the dealer can happen, so on and so forth. And lots of operating efficiencies, the signs of which you saw in some of the previous slides, which Asian Paints uses time and again to drive free cash generation that gets reinvested into technology, right? So that's the sustainable solution that a firm like Asian Paints has attempted. Now, if a new entrant comes in and uses distributors and wholesalers in their channel, because that's been their traditional model of doing other products hitherto, then first of all, they are on the back foot at the starting point, because they'll have to give some margin to these distributors and wholesalers. That itself will put their sort of prospects of any gross margin generation or profit generation on the back foot. But more importantly, even if such new entrants want to deploy a significant amount of capital to drive market share higher, they'll need to deliver inventory turns. And if there isn't enough demand forecasting going in the supply chain, it might become very difficult to deliver inventory turns from a distributor or a wholesaler shop to the end paint dealer's shop, right? So those are the challenges. It appears to us at the moment that these are not challenges which can be overcome within a year or two. It'll take time. Certainly over a longer term, they can be overcome. But also worth understanding two things that Asian Paints has done incrementally. In the last couple of decades, Asian Paints has practically not hiked product prices by more than 2 to 3% on a like-for-like basis annually, right, on average. That has not left enough room for a new entrant to come in and have some breathing space to begin with. Secondly, you also need to probably bear in mind the transition that the business is making from a product provider to more a service provider in future. And if a firm like Asian Paints becomes successful at this transition, then it's actually these types of attempted disruptions on your industry which protect you from competitive intensity in the long run. So that's the battle which we'll have to sort of look forward to. So far, there have been a couple of companies in the last 4 or 5 years who have entered, one MNC, one steel giant of India launching paint. They haven't had significant success. Never say never. In future, a new entrant might be very successful, but at this point, there is more conviction on sustainability of competitive advantage of our portfolio companies here in this sector than otherwise, which is why we are comfortable. Likewise, for say the diagnostic space, very quickly, it's worth understanding that there are two types of tests in the market. One, illness, chronic ailments related, and second is wellness related, right? Wellness related doesn't need a very short turnaround time. Wellness related can be incentivized through pricing. Wellness related is a lot more B2C with less of doctor involvement, right? Those wellness related tests, which are a minority of the market, right? That's where price wars are most intense. That's where the low hanging fruit is. And this is where I think there is scope for disruption. So, for instance, if you look at tests such as say sugar test, thyroid, lipid, liver function, kidney function, vitamin B12, so on and so forth. On these types of tests, you don't need a doctor's involvement. You're all right if the report comes with a 12-hour delay compared to another company's report, as long as it is cheaper priced, so on and so forth, right? That's where I think competitive intensity can certainly lead to burning profitability of incumbents or market share losses of incumbents. But the bulk of the market is on the left-hand side of this chart, where you need fast turnaround times because a treatment has to begin basis the report that is generated. You need accuracy of that report. Basis the accuracy of that report, you also need to build doctors' trust. And that's where when you look at the entire expenditure that the patient incurs, the contribution of a diagnostic test is relatively low compared to doctor's consultation, treatment cost, so on and so forth, right? And this is where I think the barriers to entry are far greater, far more robust. This is where it takes time to build a learning curve. This is where hub and spoke model of retail execution in the diagnostic space, from sample collection to report generation, with faster turnaround times, better accuracy, and trust building. Trust doesn't get built overnight, right? All of these factors become important. Again, never say never, and there will always be companies which will succeed in the illness diagnostics market, but that will not be just because of price. That will be because these new entrants might build businesses which are far more robust and adding a lot of value beyond price to the end customer, the doctor, and the whole ecosystem, right? Price is not the defining factor, we believe, for the left half of this slide, right? This is where the company that we hold in our portfolio operates. And hence, when you also combine that with the fact that over the last 6 years, since 2016, Dr. Lal Path Labs has not hiked the prices of their tests on the menu card. Very similar to what I talked about Asian Paints over the last couple of decades. They haven't hiked prices much. There isn't too much room available in specialist or semi-specialist testing in the diagnostic space for a new entrant to come in, add value, and still make money, right? So those are some points worth bearing in mind. And hence, for those of you who are our client would have seen, we've actually tried to use the dislocation of the share prices in the portfolio of the last couple of months as an opportunity to rebalance the portfolio and buy more of few stocks that have fallen a lot, right? So that's something that we did 2 years ago with the Bajaj Finance, something that we've done now, and hopefully that will reap rich dividends, good rewards in the months and years to come. So that's largely it. There are some stock specific comments. We'll go through those if there are questions. Over to you, Salil, if there are any questions that our clients, our viewers are asking.
Yes, Rakshit, thanks for the presentation. So let's start with one relevant question since we're talking about Tech Capex. So one question is on HDFC Bank, right? And the general perception is that from a consumer-facing tech as well as backend, maybe HDFC Bank is not quite up there as an ICICI Bank is. Are you seeing that changing? What are your views on HDFC Bank's digital or technology capabilities?
Yeah, no, that's a valid pushback. So till 2017-18, the foundation of HDFC Bank was significantly behind the curve compared to say ICICI Bank or some of the other banks in the industry. And yes, as a result, I think whether it be some of the glitches that have been publicized in media about the app not working, their website not working, so on and so forth, and also the sort of less optimal experience to the end customer using the bank interface that they do, being less digital, less system oriented. It's a valid pushback, but that was the case that we used to see at the foundation layers of HDFC Bank till 2 to 3 years ago. Particularly in the last couple of years, there's been a lot of investment in technology. Tangibly, we can see it. The channel checks that Tej and team have done have included sort of speaking to software experts in the banking industry. And we understand that there's it's a system on the mend. It's a function on the mend since 2019, pretty much under the new management team, which is giving us a lot of conviction. And particularly over the last 3 years, it's quite remarkable to see that the market share gains of HDFC Bank, both in deposits as well as on the asset side, on the loan side. So whether it be loan book market share or deposits market share, the rate of growth in market share for HDFC Bank is far stronger than the rate of growth of any other bank, including ICICI Bank, in the last 3 years. That's what gives us comfort. But yeah, this is an area where they needed a massive improvement, and we are glad that they're at least on the journey, and we'll keep our tabs on it, and hopefully this should lead to stronger fundamentals in future.
Thanks, Rakshit. In the similar vein, the question is that the access to technology or technology vendors would be the same for almost all kind of companies, right? So the vendor, let's say, who does the Blue Yonder, what they did for Page, anybody could go and employ Blue Yonder to do the same. Why is that then a competitive advantage at all?
Yeah, so there's some tangible reasons why, despite having access to the same list of vendors, different companies do tech capex in different ways and derive different degrees of benefits. First and foremost is the mindset. Very few companies invest in technology well in time, because you have to make those investments when your traditional business is still doing well, and there will always be an inertia. There will always be an inertia that so far the human being has taken all the decisions and we've been successful. And why should we substitute the human being with let's say, a robot? I'm using just some figurative examples, and hence there's a mindset shift challenge that many companies go through. So that's actually the biggest filter that ends up getting applied, and many companies are very late in their investments into technology. Secondly is the rigor that you need to follow when you implement technology. Now, A small firm like Marcellus uses Salesforce.com software, which Bajaj Finance also uses, right? But the degrees of benefits that Marcellus today is getting from Salesforce.com are far fewer than the degree of benefit that a Bajaj Finance is doing. Now, part of it is obviously the journey. Bajaj Finance's journey started much earlier. And hence today, if a new company comes in and deploys Salesforce.com software, is the length of the journey that Bajaj has already gone through and the maturity into that journey, the understanding of how to use technology to your benefit that a Bajaj Finance today has. A new fintech company using the same software will not be able to derive the same benefit overnight, right? And then on an ongoing basis, there's also an innovation angle related to this. So I'll give you an anecdote. When it comes to SAP, we've spoken to employees and ex-employees of SAP over the last 4 or 5 years who have told us that in many projects, SAP learns more from Asian Paints than Asian Paints learns from SAP. Right now, these are very strong statements that somebody can make. Right, and they're reflective of the fact that it's not the person who owns the technology or who has created the technology that necessarily also ends up being the person who knows how to use it well, right? So an Asian Paints uses SAP as a software, but despite that, there's a lot of innovation, there's a lot of thought process that an Asian Paints goes through before they decide on how to use the software to their benefit, right? And no wonder for some of these companies who have been in advanced stages of tech adoption even 10 years ago, for these companies over the last 10, 15, 20 years, you see blogs being written on the websites of large software developers in Silicon City, calling out the kinds of benefits that these sort of Bajaj Finance and Asian Paints of the world have derived by using technology to their benefit in specific. So they end up also being innovators. So it's a combination of those three layers: the mindset, then knowing what to do with the technology and the journey going through that, and finally innovating and figuring out new use cases of technology. Not many firms have that machine or the DNA to do this.
Great. Thanks, Rakshit. Now, here's an interesting question. If tech capex is increasing among CCP companies, would you consider having more tech companies in the portfolio itself because they might be beneficiaries of this kind of capex?
Right. So, look, when it comes to firms that are tech services providers or tech product manufacturers, their business model would have a different set of competitive advantages versus the business model of a traditional firm using technology to become new age, right? So our approach is more bottom up, understand the company's business model, and then buy into it if we believe it is a great business. Whether or not it's from a particular industry, say a tech industry or some other industry, that actually doesn't matter much. So the reason why we have TCS as the only firm from tech services in our portfolio is not because Indian IT services has no other company than TCS which receives demand growth, right? It's not an industry call, it's not a sector call which we've taken when we bought TCS. It's because of company specific aspects. But yeah, if we do come across tech companies with strong competitive advantages, we'll own them regardless of whether there is tech capex happening in the rest of the portfolio or not. And if there is tech capex happening in the rest of our portfolio, we'll continue to own those traditional tech deploying companies, even if we don't own the manufacturers of these tech. So it's not an industry call. It's not a theme. It's a company specific call.
Thanks. Now let's move on to the FCF discussion. So I'll combine quite a few questions which have come through here. So one interesting question that Mr. Pai asks is that why is FCFE for all CCP companies falling almost at the same time? Is it the capex part of it? Is it the earnings part of it? What is driving this all at one go?
Yeah, so there are two themes you can pick up from this slide. The first theme is all of these companies are undergoing massive raw material inflation and raw material unavailability in their ecosystem. So that's a common theme, I guess, across pretty much all of these companies. And hence, many of these companies, not coincidentally, strategically, in the fourth quarter, they've done few things to the inventory by piling up on some of the cheaper priced inventory, by manufacturing ahead of forthcoming high rates of demand. So that's what they've done to the working capital, and hence working capital is a common theme towards the decline in free cash flow in FY22. Till September 30th, 2021, you didn't see this dynamic being played out, right? And free cash flow till 30th September was actually reasonably healthy. It's only in the last quarter that pile up of inventory has happened. Also, within this pile up of inventory, the likes of, say, a Titan, a Page, and Asian Paints, right? They're also storing inventory because they can foresee that the months of April, May, June, for different reasons for different companies, these months will have far greater demand than what normally they would have seen in the preceding few months, and hence there's an acceleration in manufacturing of fast moving goods which these companies are sitting on, right? So Titan in particular, say, calling it out in their investor presentation, the quote that you can read here, the third last bullet, and Page calling it out in their conference call. The inventory pile up ahead of demand spiking upwards. Now, why are all of these companies witnessing a demand spike up? This is again the theme of market share gain that we've seen across our portfolio. The kind of capital allocation decisions done in the last couple of years have led to not only these companies surviving better through the lockdowns, through the logistical challenges, but also gain a lot of market share. And this acceleration in fundamental growth, the revenue growth rates that you saw, profit growth rates that you saw, is the reason why their market share gain probably in the coming months or quarters is expected to be higher. So those are the two parts: strategic inventory increase for managing raw material cost availability and inflation. Secondly, catering to increased demand. That's one part of it. The second part is the capex, right? So as I talked about on this slide, in the last couple of years, there's a lot of capital allocation happening in an abnormal manner. Why do I call it abnormal? These companies never used to acquire businesses till pre-COVID as rapidly as they have done during the last 2 years, right? So Page, HDFC Life, ICICI Lombard, Asian Paints, Pidilite, Dr. Lal, all of these companies have acquired either stronger competitors or competitors who have been operating in a new geography with a new product, so on and so forth, right? These are incremental additions to their revenue growth drivers, and hence they are more fuel for future growth, funding for future growth, rather than anything to be worried about. Best example is the last statement here, Pidilite, 4 times increase in capex over the last 5 years compared to the preceding 5 years. Every crisis is an opportunity, and we are quite glad that most companies in our portfolio are capitalizing on this opportunity by making these capital allocation decisions.
Thanks. A related question on FCF, Rakshit, is, again, I'm combining 2-3 questions from Vivek Pai, from Atanu Haldar. How much, is there a way you can measure what is the incremental benefit that can come from these capex? What would be, will that be in terms of profitability, growth, market share? And once this FCFE or rather this capex cycle is over, what do you think happens to the stocks? Do they follow FCFE growth, and by what time lag?
Right. So on the first part, the benefits are quite tangible, actually. Right. So let me give you a few examples. So when Page Industries did massive tech investments during FY19 and 20, right? It's worth actually going back to their EBITDA margin profile, which we might have here. Yeah, this 1Q FY20 to 3Q FY20, right? This is pre-COVID. The 5 percentage point drop that you see from 22% to 17 pre-COVID, right? This drop was because they hired a very large team of IT professionals, and they invested in technology software, right? That led to, I remember, a 400 basis points drop during these 400 out of the 500 basis points drop that you see in the EBITDA margin was separately called out in Jockey's conference calls and annual report as being attributed to new IT hiring that they've done and the tech capex that they've done. That was the immediate impact on profitability. But subsequently, you can see how, first of all, not only could they defend against, say, the likes of a Van Heusen or many other competitors in women's innerwear that were cropping up. But more importantly, they dealt with the COVID crisis. They dealt with the COVID crisis in a far better manner than any other listed innerwear company or unlisted competitor that they had. Right, the kind of revenue growth rates that you now see, the last quarter being an example of that, is an outcome of the sort of pain that they had to undergo in their financials when they were investing behind technology. So that's one way of understanding the tangible outcome. The second way to understand it is this piece, right? This is a tangible outcome of tech investments. So for Asian Paints, 7% gap in the last 5 years between earnings growth and free cash flow growth, 5% over the last 10 years, 6% over the last 15 years. A consistent 5 to 7% gap maintained between free cash flow growth and earnings growth. Likewise, for a Page Industries, right? And this gap is something that cannot be sustained beyond a couple of years if there are not consistent tech investments around working capital, around sweating your assets harder, around manufacturing efficiencies, so on and so forth, right? So that's the second tangible benefit. The third tangible benefit is the customer is becoming a lot more tech-oriented. Raw material vendors are becoming a lot more tech-oriented. And hence, if these companies don't become tech-oriented, they will get disrupted by new age competitors, quote unquote, right? And hence it's a defense rather than a tangible add-on to a revenue growth or an earnings growth or a free cash flow growth. It's a defense which provides longevity, which provides sustainability to free cash generation in the long run, right? So those are three different levels of, I would say, quantifiable ways to understand the outcome of these tech investments. Now, coming to the second question, which is how soon will the share prices catch up with free cash flow compounding? So typically, we've seen that over a 5-year period, on a rolling basis, share prices start having a 1:1 correlation with free cash flow. Over a 10-year period, there's a very strong 1:1 correlation. It doesn't get stronger beyond 10 years. I mean, 15 and 20 years is equally strong. But you need to wait for about a 5-year period for either free cash flows to catch up with share prices that have anticipated increase in free cash flows, or for share prices to catch up with free cash flows if initial drop in free cash flow has been a concern for the market, right? It can happen actually both ways. And also worth understanding this element via the little chance rising giants, consistent compounders, progressive construct. Little champs are companies where share prices run far ahead of free cash flows because there are practically very little or no free cash flows when these companies are investing pretty much their entire operating cash flow into capex. Rising giants typically are companies where where over the last 3-4 years, they've gone through the inflection point where Capex is less than operating cash flow in order to fund growth. And hence, for the first time, these companies start generating free cash flows, and free cash flow CAGR then catches up with the share price progression that has already been there. In many cases, the share price progression also accelerates when you go through that inflection point and become a rising giant. And CCP companies see what you can see in the chart on the right, which is free cash flows drive their share price compounding more than earnings do. And hence, actually related to the point of valuation as well, then you don't see the price to free cash flow multiples go up meaningfully for these companies progressively, even though their price to earnings multiples have gone up. And that's only because earnings are not the biggest drivers of free cash flows anymore. There's much more beyond earnings that these companies are doing, and hence the share price reflects that over a 5-year period.
Great, Rakshit. Thanks. Rakshit, the next question is a little macro, and it is that how does inflation hurt the portfolio, especially if you have non-essential goods in stocks, companies which engage in non-essential goods or produce and sell non-essential goods. So it would be nice to actually also indicate that what is our philosophy on buying a lot of the essential goods.
Sure. So there are few layers in which inflation can have an impact on your portfolio companies is fundamentals. The first layer is because of inflation, the industry demand itself might collapse if the underlying product is a little more discretionary in nature, right? The more discretionary the product, the less essential the product, the greater the demand collapse risk if inflation shoots through the roof for the overall industry. And no matter how strong a competitive advantage you have, if you are in such an industry, then you're exposed to massive volatility in your fundamentals because if the industry demand itself has halved, no matter how much market share you gain, you won't be compounding at 25% or 20% CAGR. The second layer where inflation can hit is inflation is also feeding into the expenses of many of these companies, whether it be wage inflation for, say, a labor oriented manufacturing firm, whether it be raw material price inflation, whether it be freight cost inflation, right? So various types of inflation, they hit the P&L, they hit the income statement of these companies. That's when competitive advantage comes to rescue if the business has it. A business that has a very high degree of competitive advantage can do what let's say this chart shows these companies have managed to do, where yarn prices have doubled, but Page Industries' gross margin is still at an all-time high, right on this chart. So that's the second layer where there is a possibility of a defense in the form of competitive advantages, but not too many firms possess that defense. And then there are second order effects because of inflation. If the governments hike interest rates, and then you as an investor are buying into companies which are raising capital to fund their growth, that source of capital dries up, and the business prospects then get diminished. Those sorts of risks are sort of the second, third layer. And this is where, as Salil rightly pointed out, especially on the first part of inflation's impact, where discretionary versus essential, we prefer companies which are selling products of day-to-day essentials. And secondly, on the competitive advantage side, we prefer companies which are selling products where the value add to the customer is not just the price. Value add to the customer is far more than just the price, whether it be demand forecasting led inventory turns for paints, or whether it be trust built with the doctor and faster turnaround times for diagnostics, or whether it be high quality innerwear with affordable pricing and an aspirational brand available in the nooks and corners of the country for Page Industries, right? So the reasons why the customer buys the product from you should not be about the price. And in fact, the more affordable you've made the product for the customer, the more de-linked the customer's decision making becomes from the price itself, right? So those are the two defense mechanisms in our portfolio against inflation: day-to-day essentials and deeply moated companies where the customer's purchasing decision is beyond just the price.
Great. Thanks, Akshat. Now we'll take a couple of questions on the portfolio before we move on to the stock-specific ones. So that's an interesting 2 points of view. So Gaurav Kumar says that he agrees with the philosophy, and he's suggesting that we should not make any changes to the strategy or the approach given the market conditions. And then Sri Hari Iyer asks that things are bad. FCFE has declined. Are we doing something to make sure that things don't go bad even more? So do we change the strategy or do we change the approach?
Sure. So let me answer the second question first, and then it'll answer sort of the first question as well. FY17 had a negative free cash flow for the entire portfolio. FY13 also had a negative free cash flow YOY. FY9 and 10 were both years of negative free cash flow. This is a recurring phenomenon. Whenever there is an opportunity to press your foot on the accelerator to do Capex in a difficult time when that Capex adds value, builds more competitive advantages to your business, whenever you see that, the strongest of businesses get into the investing mode. If you get into the investing mode, you will see a decline in free cash flows for a year, max 2 years. But as long as your returns on capital employed are high and increasing, your revenue growth is strong and increasing, you don't need to worry about the fact that for 1 year, free cash generation didn't happen. Because return on capital employed being high and increasing is a clear reflection of the strength of the business increasing. Secondly, revenue growth accelerating is an outcome of the Capex that you're doing. In exchange for that, for 1 year, free cash flow will be volatile. And no wonder, as a result, in none of our presentations historically, you would have seen us talk about 1 year YOY growth in free cash flow, right? Free cash flow tends to be far more volatile than profits. And hence, you always need to look at either a cumulative free cash flow for a 3 or 5 year period or a 5 year CAGR, 10 year CAGR instead of just 1 year YOY. Now, answering the second, the first question, sorry, basis this. To begin with, there is no philosophy, no fund manager globally who would have outperformed versus their benchmark every year over, say, a 10, 15, 20 year period. Every philosophy, every fund as a result based on that philosophy is bound to have periods of underperformance. As long as that underperformance is temporary and absolute return in the long run is healthy, there is no need to even think about what might be wrong with the philosophy. Now, if there is something that we can change to improve the philosophy, to enhance the philosophy, we will do it, because the world around us is evolving and our philosophy might also need to evolve. But just because what has happened in the last 6 to 12 months, despite fundamentals of our portfolio companies being strong, is not a good enough reason to change the philosophy. And we are not going to change our philosophy of investing because of this. You need to be disciplined when we invest. It's far easier to say that I'm a long-term investor than live through sort of periods like this. It's not very happy moment to have a bad absolute or relative return, But if it's a temporary phenomenon and underlying drivers are strong, then we need to hold on. And hence, yeah, we are not going to change the philosophy in this fund.
Thanks, Rakshit. Folks, hope that addresses concerns on that part. Now we'll move to stock-specific questions, and there are actually many on Asian Paints and increasing competition. One common thread there is that what if Grasim does not want to make the same ROCs as Asian Paint does? Right? They operate at lower margins and they're happy with that. How will Asian Paints respond? Related to that is what happens to Berger? If let's say Asian Paints does or does not get impacted, how would you see Berger's fortunes in this increasing competitive scenario?
Sure, a good question. So for both of these companies, Berger and Asian Paints, the answer has to be the same, which is that even if a competitor is willing to burn a lot of cash, do we see threat to market share or profitability for a couple of years? If we do, we should take some action. If we don't, then we should not take any action at this stage. Currently, we don't see that. Why? Think of it like this. When you step into the mind of a paint dealer has limited capital employed in the form of fixed assets, the shelf space in the store, in the form of working capital, right? The cash invested in buying the inventory before it gets sold. This part of capital employed, both fixed asset, which is the real estate oriented, and working capital, right, needs to generate some return for the dealer. A discount offered by a new competitor, where instead of say 3% margin, the dealer makes 6% or 9% margin, with inventory turns which are 1/5 or 1/10 of what Asian Paints offers, that discount has no benefit to the dealer. And this is something which is worth understanding. Nerolac, Dulux offer far greater discounts than Asian Paints does on their products to the channel, far higher margin than Asian Paints does to the channel. In 2006, Sherwin-Williams entered and they gave 15% margin to the channel compared to the 3% margin that Asian Paints' channel makes, 5 times higher margin. But in exchange, for the dealer to make economic viability via Sherwin-Williams' products, they needed at least 1/5 inventory turns. And delivering 1/5 inventory turns, which means instead of 3-hour delivery, you at least do once a day delivery. Doing once a day delivery in a voluminous product is difficult. Sherwin-Williams is the largest paint company globally with the deepest balance sheet, and it is an equivalent of a consistent compounder in America. It is not a poor quality company, generates truckloads of cash, return on capital of 20%, and very healthy growth rates, all resources needed to get into India in a serious way, which they did, burn cash if needed, make their foot through the door, and then bigger presence felt in the country. 2011, after 5 years of doing that, they exited, sold their business after having generated around 100 crores in revenue. They sold their business to Berger and left, right? Why could they? And they spent, by the way, $1 billion in CapEx, right? 5,000 crores plus. They set up plants, set up supply chains, etc. Why couldn't they make any dent in 5 years? It's exactly this piece. Right, it's difficult to forecast demand, and if you can't forecast demand, then just by cash burn, you can't take market share so easily. Now, having said that, maybe Grasim does a great job at it when they come, but just because they will be willing to burn cash is not a strong enough reason for us to make changes to our portfolio. We'll keep an eye out on their approach, on their strategy. If there is something that that we think is material and needs to be reflected in our understanding, then we'll take corrective action at that time. But yeah, I mean, we would had an investor sold Asian Paints when Sherwin-Williams entered because they were doing $1 billion of capex. At that time, $1 billion is far greater than today's $1.5 billion, which this new competitor is doing. Yeah, it would have been a wrong decision for investors to take at that time.
Would you think in a similar way for Berger also?
Yeah, so Berger at the moment, yes, it's delivering very similar, if not the same, inventory turns, and it's adding value on the margin a little bit more to catch up with the higher inventory turns that Asian Paints delivers. And hence the net value add that Berger is giving to its customers, its dealer network, is similar. So yeah, so the answer has to apply in the same way, both.
Great. One another stock which is facing competitive pressures is Dr. Lal. Now, you have spoken about this, but it would be really helpful if you can clarify, is there any fundamental or is there any problem with fundamentals going ahead? I think the questions also stem from the fact that there is this confusion about COVID, non-COVID revenues. So if you can help clarify both points, that would be helpful.
Sure. So COVID, non-COVID is an easy one. I mean, nobody should have bought Dr. Lal thinking that COVID revenue will keep going up. I don't think the market did that either. So COVID, non-COVID is not something that should be worried about. You should only look at non-COVID revenues of Dr. Lal or for any other diagnostic player for that matter. Non-COVID for Dr. Lal has been going from strength to strength, and we've discussed that in our newsletters, in our previous webinars, etc. The concern is more on competition. And this is a space, let me acknowledge, this is a space which is evolving. The way diagnostics is done today will not be the way diagnostics will be done 10 years from now. Just like, say, in the traditional supply chains of FMCG, e-commerce has come in and changed the rules of the game a little bit, or meaningfully, I would say. The diagnostic space will also evolve, not exactly in the same lines, on the same lines as e-commerce and FMCG, but in some ways similar, right? There are differences between FMCG and diagnostics. The trust element, for instance, right? Why is Dr. Lal different from a standard retailer? Why is Titan different from a standard retailer? This trust element which comes in certain categories becomes a massive barrier, provided it's important to build that trust. Trust can't be built overnight, right? So that's how, to begin with, it's worth acknowledging that the space in which Dr. Lal operates is evolving. Now, in that evolving space, the call to be made is Dr. Lal a sleeping traditional business which will not evolve at the pace at which the ecosystem is evolving and will face disruptions? Or is Dr. Lal alive and awake to the needs of evolution of their business in order to stay relevant in front of the customer, and in fact, in order to benefit from the strong position that they have, where they've currently got a customer franchise, they've got a backend, they've got the trust built with the doctors, they've got a brand, so on and so forth, and they have to evolve around that, right? They are in a stronger position to evolve, provided they can cross that. I think, Salil, you asked that question of what stops a company from evolving fast enough is the mindset, the investments, and then the innovation on top that you need to do. If Dr. Lal does that, then they'll stay relevant and in fact become stronger in front of their customer base. Currently, we believe there is enough evidence out there, and we are convinced that they will be able to do it. Particularly the kind of competition that so far has come. So far, the nature of that competition is more for the slide, the flow chart on the right-hand side of this slide, right? And that's the flow chart which doesn't bother us so much. But if a Tata 1mg, if a Farm Easy they transition materially from the right-hand half of the slide to the left-hand half of the slide. Remember, Thyrocare couldn't build competitive advantage against Dr. Lal when they attempted a price war in 2016-17. They couldn't take market share away from Dr. Lal in any meaningful manner. So if these sort of new age companies or new entrants, they do transition from right half of the slide to the left half of the slide successfully, then yes, there will be relevant questions around competition, etc., and which is the space we are watching out very closely. Currently, we are convinced, but again, as I said, never say never, neither for Asian Paints nor for Dr. Lal. If we see competition succeeding in any way and sooner than our companies succeed in the evolution, then we'll take corrective actions. But this is not limited to just Dr. Lal or Asian Paints. If you remember 3 years ago, Van Heusen against Jockey was the same. They were willing to burn money, and they built, I think, 300 crore worth revenue from zero within 18 months by burning, I think, 60 to 80 crores a quarter. Right? So they did that, but they did it in a highly unsustainable manner. And anybody who sold out of Page Industries in 2020 or 19 because of that would have made a mistake in hindsight. Certainly, we can say that today. Likewise for many other companies in our portfolio. I mean, there was a whole host of new jewelers who suddenly started their journey towards becoming pan-India jewelry retailers. Kalyan, Joy Lucas, and PC Jewelers, TBZ. They came, they made an attempt, but it's not difficult to build the kind of competitive advantages that Titan has, and hence Titan thrived. So yeah.
Great, thanks, Rakshit. So we have time for 2 more questions, again stock specific ones. Rakshit, the next one is again 2 or 3 people have asked about Nestle, and how do you see growth in Nestle? Is there a market saturation that you think Nestle is approaching?
Right. So in Nestle, honestly speaking, there's a lot happening behind the scenes, which is the reason why their profit growth, free cash flow growth has been very healthy in the last 3-5 years. The profit growth, free cash flow growth has been 20% plus over the last 5 years. And the reason for that is, why do you not see that in revenue, but you do see that in profit and free cash flow? One, they are undergoing a massive portfolio rationalization. You might remember UHT milk, everyday dahi, right? Dahi, mishti doi. All of these products used to be advertised quite heavily 5, 6, 7 years ago. They've been de-emphasized. They've not been stopped or discarded. They've been de-emphasized in Nestle's portfolio. And this sort of a product rationalization that is underway is the reason why overall profitability is compounding at a healthy pace, whilst revenues aren't, right? So that revenue number is a bit of a mathematical outcome of portfolio rationalization. That's the first bit. The second bit is under Suresh Narayanan as the new management leader who joined after the Maggie fiasco. He has brought in a lot of culture of operating efficiencies. On average, there's been 120 to 150 basis points of operating margin expansion. On top of it, asset turns have increased. The more recent manufacturing plants that have come up, such as say the Sanand plant and all, they are far more asset turn oriented than their previous plants, so on and so forth, right? So that's the direction in which this business is evolving. And hence, when you actually look at Maggi, KitKat, Nescafe, there's very good growth, volume, value, and leading to overall profit and free cash flows being in a zone which would satisfy our expectations.
Great. We'll take the last question on DVs. If you go back to the table that you showed on DVs, the FCF growth right, versus OCF or EPS growth, there is a clear divergence, which you have already explained, which is the case in many companies. Do you think Divi's deserves, say, a higher allocation in the portfolio, given that there is a lot of capex happening, which will translate into very high future growth?
Yes, no, this is a company which is massively benefiting from the quote unquote China plus one. Additionally, this is a company which backward integrates to derive more and more operating efficiencies. And hence the capex that they're doing is in light of that. Obviously, when they give guidance to the market, which is, I think, one area where the market was probably disappointed this time round, when they give guidance to the market, they won't be disclosing these details, and the kind of confidentiality agreements they have with their end customers, we won't even expect them to do so. But yeah, given the strength of the business, the tailwinds that it is experiencing, the capex that Divi's has done, literally they've doubled their capacity in the last, I think, 12 months or something, is a massive driver for growth in future, and hence we continue to hold on to it. The reason why we have a lower allocation than what probably the questioner is indicating we should is not because of the free cash flow growth. There are many factors, risk factors that go into our position sizing. And if you are aware of our longevity framework, we've demonstrated that in various other webinars and newsletters. On a couple of risk factors, the score of Divi's is low compared to what we would like a high allocation company in our portfolio to have, and hence the allocation is low. It's not because of our expected free cash flow compounding. In fact, our expected free cash flow compounding here is amongst the highest, one of the higher ones in the whole portfolio.
Thanks, Rakshit. Folks, thank you very much for your questions. Unfortunately, we have run out of time. If you have any more, please write into us, and we'll make sure we try and answer as much as we can. So thank you again for attending. Thanks, Rakshit, for your time and for answering all the questions.
Thank you, Salil, for coordinating. Thank you.
Bye.
Bye.